In our first video from 2 weeks ago, we talked about Warren Buffett's favorite stock, that is Apple, and that it was the most valuable company in the world. But since then, a lot have changed. Apple stock is down 1.6% year-to-date, and Microsoft is up 5%, and now Microsoft is the most valuable company with a market cap of almost $2.9 trillion. So in this video, we take a look at Microsoft stock to analyze it and see what we think of the valuation. Let's start with an overview of the stock. We see a price of just shy of $390. The revenue in the last 12 months was $218 billion with a net income of $77.1 billion. That is a profit margin of 35.3%, which is really good. They have earnings per share of $10.33, and with the current stock price, that means a PE ratio of 37.6. This is high, especially for such a big and old company, but given the growth and margins, it makes sense why investors are willing to pay a higher valuation. And they pay a dividend, but that dividend yield is just 0.7% at the current stock price. The next earnings will be published in just 4 days. In the last 5 years, the stock is up 261%, and in the last year, that is 65%. This, of course, has to do with AI, where Microsoft has a partnership with OpenAI, and they own half of OpenAI. They benefit from the models like ChatGPT, but also are able to offer these services to businesses and customers via their Azure platform. If we look at the scorecard, Microsoft currently has a score of 73 out of 100. They score no points for valuation because the ratios are much higher than we like to see. But given the opportunities in their margin, the higher valuation at this moment can be explained. Looking at the growth the last 5 years, we see it scores all points. We see a revenue growth of 11% compounded per year and net income of 13% per year. Also for management and profitability, it scores all points, where we see 28% free cash flow margin. For dividend and analysts, it scores 10 out of 15 points, and that is because analysts have an average price target of about $350, which means a 10% decline from the current stock price. When we look at the charts, we get a visual overview of a lot of data. We see a nice growth for revenue and EBITDA for the last 10 years. Net income shows a nice growth in 2019, probably because 2018 was not that good. Free cash flow in 2023 was a little lower than the previous year, and we have to mention that the fiscal years of Microsoft are not the same as our calendar year. We see earnings per share growth over the last 10 years, because improved net income, but also because we see shares outstanding decline every year. Microsoft is able to invest their money at great profitability if we look at the return on invested capital, and in the last 10 years we see a slow growth on average to even 30% in 2022. Finally, we see the margins of Microsoft. The gross margin looks kind of flat or even slowly growing in the last 8 years. But for the net margin, we see a great increase since 2019 and has climbed to around 35% in the recent years. Microsoft does pay a dividend. We saw it was only a dividend yield of 0.7% at the current stock price, but that still is $2.80 per share for the last 12 months. The current payout ratio is 26%, which is very good and leaves room to increase the dividend in the future. If we look at the chart, we see the dividend in the black line, and it is always much lower than the earnings per share in blue or free cash flow in green. Even in the years where profit is lower, Microsoft still earns enough to pay the dividend. We already saw in the scorecard that analysts have a price target that on average is 10% lower than the current stock price. The most negative analysts even has a 40% lower price target, while the most positive analyst has a price target of $455 or an upside of 17%. On average, we see analysts expect around 14 or 15% revenue growth for the next few years. Earnings per share growth is a little higher, probably because of declining shares outstanding, and there we see percentages of 14 to 20% per year. Currently, there are 34 analysts, 14 have a strong buy rating, but also there is one strong sell rating. After all this data, it is time to look at the valuation of Microsoft. And more important, make our own calculations to see what we think of the current stock price based on our predictions for the future. Let's start with the multiples valuation. Here we make a valuation for the next 5 years. We see revenue growth of about 11% per year for the last 5 years and 9% for the last 10. On the right, we see analyst predictions, and those are a little higher. So we go with 7, 10, and 13% revenue growth per year. The profit margins have improved in the last few years, and we think they can be improved a little more in the bull case, so 30, 33, and 36% profit margins. Shares outstanding keeps declining between 0.75 and 1.25% per year. Then we come to the P/E ratio, a very important part of this valuation. This is the multiplier at the end of year 5 to multiply the earnings per share. Now we see a P/E ratio of about 37, while for the last 5 years it was 28 on average, and in the last 10 years it was 22. That's why we use 22, 26, and 30 for the P/E ratio. Our required return is 9, 10, and 11%, a little higher than the average of a well-diversified ETF, but not much higher because we think Microsoft has a good position and well-diversified revenue. When we click on Make Calculation, we see 3 prices pop up, but all 3 are in red, meaning that what we want to pay for the stock is lower than the current price. If we believe the bull case, we want to pay about $369, and that is very close to the current price. But for the base case, the most probable scenario, that price is only $265 per share. When we click on Show Calculations, we can see the assumptions and returns per scenario. In the base case, we see revenue grow to $351 billion, an earnings per share of eventually $16.42, and with a P/E multiple of 26, that gives us a stock price of $426. That means a compounded annual growth rate of just 1.8% per year if we buy it at the current price. A positive return, but not the required return of 10% in this scenario, and not even what we can expect from a well-diversified ETF. So let's also value the stock with our discounted cash flow tool. We see free cash flow growth for 8 out of the last 10 years. On average, that growth was 4% for the last 3 years, 10% for the last 5 years, and 9% for the last 10 years. For our calculation for the next 10 years, we use 9% free cash flow growth, 3% perpetual growth after these 10 years, and a discount rate of 10%. If we calculate, we see a price of $193, way lower than the current stock price, and that's why it is in red. If we lower our discount rate to 7%, the price rises to $356, but still not the price we see at this moment. So also based on this tool, we think the stock is overvalued. Finally, we take a look at the chart by Peter Lynch. He used to make charts where you put the stock price on one axis and the earnings per share on another. The idea is that eventually these should be in line, because stock price always follows earnings. When we take a look at the charts, we see the stock price is now way above the blue line of the earnings per share. This also happened in 2022, while in late 2022 and early 2023 we saw both lines were close together, indicating a great moment to buy the stock. If we zoom out to the last 30 years, we see a similar situation during the dot-com bubble of 2000, while between 2007 and 2014 the stock seemed undervalued. So this tool also indicates the stock looks overvalued at this moment with the stock price. But that is based on our expectations. Let us know what you think of Microsoft stock and its price in the comments down below. Also, do not forget to subscribe to our channel to never miss a video in the future, and we also keep you posted when our website goes online so you can do your own research. Thanks for watching, and we hope to see you in our next video.